The markets kind of just shrugged it off. And the reaction has been startling. We've seen this kind of price action before. But this is not going away. It'll come back tomorrow. It'll be a factor when we analyze markets in the coming days, weeks, months as well. And what this graphic basically tells you is what the market expectation of the Fed funds rate and how that has moved. This is Fed funds rate and where it is likely to peak, what we describe as the terminal rate. How much will the Fed hike to ultimately before it pauses or before rates start to drop, right? And this is all the way from January of this year to today. Now look at this. In January of 2022, market expected that the peak Fed funds rate, you basically will need maybe 2 rate hikes of 50 basis points and you'll be done. Look at what happened, where we were in April. It is 2.5% was the expectation of where the peak rate is going to be. By this time, the FOMC, the Fed had started to say that we'll need to do a lot more. This also is a graph which shows you the disbelief that the market has had that the Fed's not going to go all the way. This is not Paul Volcker 2.0 as many are now saying perhaps it is. Look at what the expectation was in June, 3% and done. A pause or maybe cut or whatever. Last week that was 5% or so, under 5% actually, and post the rate hike, the Fed funds expected sort of peak rate, the terminal rate has moved up to 5.5%. This yellow line, by the way, is nothing but the actual Fed funds rate. We're at 4.75%, and after yesterday's decision and the hawkish talk by the Fed chair, the expectation is that this 4.75 will go up to 5.5, another 75 basis points before they kind of stop and maybe keep the rate there for some time to come. So this is, I think, a pretty startling kind of graph which shows you the gap between what the Fed kept saying it will do and the market kind of saying, well, probably not. Let me just quickly read out just one portion from Fed Chair Powell's comment, which basically highlights that according to him, the risk of not tightening enough is far higher, the damage it can do, than to over-tighten. So it's, in a way, what he's saying is it's better to over-tighten. And this is what he said, and I quote, if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we are in a situation where inflation is now entrenched and the employment costs in particular will be much higher potentially. So I think this is as clear as they come. We were expecting that the Jackson Hole 8-minute speech is as strong and clear as any, but I think last night it was pretty clear too.